And welcome to today's Financially Speaking Monday Morning Money Briefing. I'll just share my screen so we can see what we're all here for, which is, of course, today's Money Briefing, where we break down some of the key headlines from last week and hopefully translate them into what they mean for you, your investments, and your steps to financial freedom as well. I'm just going to share a link in the chat that allows you to ask any questions that you might have whilst we're going through this live session here. And there's no such thing as a silly question, as is always the way. So don't feel that whatever it is that you might have in your mind is too insignificant or not related or just kind of sometimes obvious, because the headlines don't always make it super obvious, and neither do the translations to what it means for your investments. But of course, if you are watching this recorded after today, or indeed if something comes up in the middle of the week that just pops into your mind or that you see in a headline, don't hesitate to reach us at hello@myfinancialfreedomcoach.co.uk, where you can ask away any questions that it is that you might have, and we'll do our very best to either weave them into next week, because of course we're here today, next week's live. And we can also try as well, wherever possible, to reply, break them down for you, and get back to you as well. And it's worth me noting too that actually we have a wait list for our group coaching as well. You can find that on our website, along with an intro call for our one-to-one. We do one-to-ones, and we're now launching this new group coaching, and you'll be able to find all of that on our website. But again, if you've got any questions, just drop us an email or indeed book us in for a quick 15-minute call. I will crack on with what we're all here for today, which is today's Monday Morning Money Briefing. So if you're new, hello and welcome. It's great to have you here. If you've been to a few, you'll know the drill. But the agenda of today is, firstly, I'm going to go through one thing I've done to get that little bit closer to financial freedom before going into what's happened in the UK, the US, taking a look at a read of the week, and looking at the rest of Europe as well. So one thing that I've done to get me that a little bit closer to financial freedom is I've had a little bit of a route around, a bit of a research on some sustainable investing themes. It is such a minefield. If you are looking at sustainable investing, there is no simple solution, and there's an awful lot of contradictions in it. I could talk about it for hours and hours, years and years, and maybe I will do in some other webinars and some other updates as well. So it's not to get too much into it now, but it's certainly been interesting. One thing that I would say is that one of the reasons why I find it so interesting and why I ended up going down a bit of a rabbit hole again of research in terms of my own investments and what that looks like is because it's constantly changing. The way that we look at sustainability from a global perspective, but then also from an investing lens as well, is always moving and shifting. And that means that from a strategy perspective, we have to keep a little bit on top of that as well. And honestly, it had been a while since I'd done that. So it was time to just have a look at how it compared with some of the investments that I'd chosen, thinking that they were the more ethical and sustainable leaning ones, and what that looked like now as well. So many conundrums and so many dilemmas, and it really does get you thinking. But one thing I would say is, if it is something that's important to you, do just have a check-in. There's loads of websites out there that can help with various different comparisons, so do take a look. On to then the markets last week, where unfortunately it was a bit of a sea of red. Nothing too dramatic before anybody panics, but what we're seeing is that the FTSE 100, the measure of the 100 biggest companies in the UK, fell by 0.9%. The S&P 500, so the measure of the 500 biggest companies in the US, fell by 0.47%. The NASDAQ, which is often seen as the tech-heavy index, fell by 0.24%. And the Euro Stoxx 50 fell by 0.58%. So we can see there that across the globe, the vast majority of major indexes were indeed down. We're, of course, going to get into why this is, but it links really crucially to what we're talking about a lot at the moment, which is that it is just incredibly volatile on the markets. And whilst that volatility has led to some good weeks over the last few weeks, inevitably, there's always going to be some that don't quite turn out so rosy as well. And last week was just one of those examples. Now, we're due some major earnings reports this coming week. So earnings reports are basically when companies tell us how they're doing, how they've performed. Some of the major ones on the US stock market, notably big tech companies, are set to tell us how the last quarter went. And what this can mean is even more volatility as well. So I'll set it the scene now that this time next week when I'm back and we're still looking at red, you might be thinking, I thought Zoe said it was going to be up and down and hopefully this week was going to be up. It may well be another tough week. We might be in for a few tough weeks, but these are all relatively minor numbers. These drops aren't anything particularly dramatic. And as I get into it, you'll see that there actually was a bit of a swing in the week. So you can use these figures to hopefully stay calm and just keep listening to what I've got to say and keep listening to the logic of the long term. Whilst the short-term volatility can be quite panic-inducing and can really make you think about what you're doing with your investments, having that long-term view in mind is really, really key, particularly in tougher times. Keep those bigger goals in mind, keep the things that you're working towards in mind, and it'll just make it so much easier to ride out those tougher times. So what happened then in the UK? Well, news came out of the UK around UK government borrowing. UK government borrowing actually fell sharply in December, and this was all because tax receipts, as we spoke about last week, were on the up. This meant that there was an eased pressure on public finances and it helped to boost markets as well. So essentially all governments, the UK and many others as well, have to raise money from somewhere. Often this is done via tax receipts. Now the UK changed various different taxes, and what this meant is that the revenues increased from last April. Now the impact of that is starting to be seen and the government brought more money in. Some of you might be sitting there in the UK thinking, for flipping heck, that's really frustrating. Then that means that we're paying more in tax. It's rarely a popular topic, but what it does mean is that there's been easing on the government's pressure to borrow to be able to raise money, and usually that's looked upon favorably from an investor perspective, not just from the markets but also from attracting more global investment, which can mean in time more infrastructure in place and more longer term growth. So try and see it all as a relatively good thing, even if it's not in that short run a little bit painful to hear out loud. So what does all this mean then for you and your investments? Because whilst that lower borrowing levels of the UK government reassures investors both from a market perspective, but also from that wider investing perspective in terms of money coming into the business, it can also support things like bonds and stocks that are closely tied to bonds. But it's not a quick game. It's actually going to take a little bit longer than that. So this is more of kind of a long-term positive news to take away and feed back into your investments. The UK looked really, really strong from a market perspective last year, which you'll know if you've got investments in, for example, the FTSE 100 or UK-based stocks. What this news suggests is that the government is paving the way slowly, to keep those investment levels looking strong and to also hope that market performance continues in that upward trajectory as we saw in the last year. It's certainly not bad news from us and our investments perspective, particularly if you've got investments in the UK or indeed if you are sat in the UK and looking at your finances as well. So some good news after all of those red figures that kicked off this week's market update. So over the pond then in the US, where it goes without saying, a lot of the ups and downs were, of course, generated. And what a lot of this was owing to was that there was fears of a potential trade war globally as Donald Trump threatened to impose tariffs on various different European countries who were opposing his various different plans with Greenland. Now, we spoke about Greenland last week, of course, because this has been rumbling on now for a few weeks, but the news of the potential imposition of tariffs was relatively new and novel for the week. Off the back of his announcement of this, stock markets really tumble. Many were seeing it actually as a potential negative. And it goes without saying, certainly something that could rock the global boat a little bit. So what lots of people did was, of course, sell their stocks and turn towards the greater safe havens, one of which is gold. Gold surged once again in value to around the $5,000 per ounce mark. We saw all through last year more and more headlines around gold hitting all-time highs, and this is just another example of gold surging. Gold represents a real safe haven. It's kind of called that amongst investors because, well, firstly, it's tangible. We all know what it looks like. We've probably all at some point touched it, seen it. Even if we've not invested in it into a traditional way where it's maybe put away in a vault and locked up and hope to grow, then we perhaps have invested via jewelry and the like, and therefore seen the value ourselves go up. And people like this level of certainty in times of intense uncertainty like what we're seeing right now with Trump and the relevant stock market reactions as well. We're also seeing a relatively new and novel situation whereby the US dollar is weakening quite considerably. The US dollar as a currency has represented, if not the global currency. And what this has meant is that many investors not just use the dollar to buy other investments, but also hold the dollar as an investment themselves. Now, as these tariff threats have come into place and Trump has made ever more outlandish claims about various different things, the dollar has become less and less appealing in the term of his presidency. And of course, we've still got 3 years left of presidency, which many will be considering when holding their dollar investments. So what has been a previous other safe haven when it comes to the US dollar is now eroding. The likes of gold and the known knowns, the known quantities become ever more appealing, pushing up the value even more. So these rising gold prices may be good if you've got them present in your investing portfolio, for example. Many of us will have gold through the likes of multi-asset portfolios. Equally, we might not have any gold, but we might still see the benefit through the likes of mining stocks and other gold-related stocks that are tied to these kind of safe havens. But what it can signal is really fragile confidence. Often, whilst I'm saying these all-time highs are great news, they can be seen as great news, but it might also be seen as something that's a real indicator of quite how fearful stock markets are of the next announcement of Trump and whatever it may well be. Of course, if you've been following the Greenland news, by midweek, Trump had changed his mind and the tariffs were back off the table and relevant discussions had taken place and he decided it was no longer going ahead. And markets responded relatively positively to that news and came back up again, just not up enough to be up by the end of the week. If you looked at a graph of last week, most of those stock markets that we saw at the beginning went all the way, down and back up, kind of like a V. But the other side of the V wasn't quite as big as the drop. And so what this really does just go to show is that diversification within our portfolio could never be more important. Whilst the gold is soaring to all-time highs, there could also be fear around these all-time highs. Often that's not something that is particularly favorable with markets or investors. There's only so long that can go on for, and people hold their nerve for as well. There may also be other assets that do particularly well in these tougher times, defensive assets. And I'm not talking about the defense sector, but rather assets that generally perform well in tougher times. Often we see these as the likes of consumer goods, utilities, and sometimes as well in that basket, health too. There could also be a greater argument more than ever for non-US markets, whilst a lot of the literature that we read around investing focuses on the US and focuses on the growth of the US stock market, which has been historically very, very strong along with the dollar. Actually, what it overlooks is what is currently going on right now. So diversification within your portfolio, and what this all means is that it's just never been more important. On to then the read of the week, where an opinion piece in the Financial Times went through the pensions triple lock that we have here in the UK. State pensions are linked to inflation via what is known as the triple lock. What this basically does is it makes sure that the state pension goes up with inflation, but crucially that inflation, or this triple lock, is measured in 3 different ways. And that means that actually it's pretty much guaranteed that the state pension will continue to rise in a very, very favourable fashion. There are ways in which the state pension could still rise with inflation, but be less favourable, less dramatic, if you like, for those receiving the state pension. So this relatively humorous opinion piece, I would suggest that you read it if you've got a few extra minutes this morning or later in the week, argues that although this UK state pension is not unusually generous, in fact, we have a relatively low level of state pension here in the UK, the triple lock is increasing costs and is set to continue to do so because it is such a generous increase when we're talking about that going up with inflation. It's politically popular, generally, to be seen as giving out relatively large amounts of money to pensioners, or at least to be giving them favourable schemes because they're not large amounts, but most would see it as relatively fiscally unsustainable. This is likely to be a topic that pops up all over the globe. We are seeing pensioners live longer and longer, and those state pensions become ever more unsustainable. Couple this with the likes of increased pressures on defence spending, and the topic just gets ever more thorny and ever more discussed as well. There'll also be some quite difficult conversations around intergenerational fairness and what kind of taxation levels we see on pensioners and how much the working generation is expected to pay in taxation levels. So it'll likely be a tricky topic that many governments have to face and will continue to face in this period and into the future as well. So it's a really interesting read and certainly one to take away. For me, the key point is that we need to be self-sufficient, and having an investment portfolio means that you've got something for yourself when you get to retirement, and you're not just relying on political changes around the likes of how they pick their inflation increases and what that means for you and your livelihood as well. Let's take a look then at Europe, where the European defence firm Czechoslovak Group saw the world's largest defence IPO on the Amsterdam Stock Exchange. This really goes to be a sort of sign of the times. It's showing the strong investor demand that we're seeing at the moment for military-tied stocks. It's also seeing the booming European defence sector. Traditionally, a lot of defence has emerged from the US, but Europe are really developing some of their own companies and are seeing the sector boom as well. It highlights this kind of structural shift that is taking place within geopolitics, but also therefore within the stock markets. European markets are looking pretty strong for the year, and a lot of this is owing to the boom in many of the different defence companies. It's also helping with the growing view on supporting Europe's IPO pipeline. So for anybody that's unaware, an IPO is just the first time that a stock lists on a stock market. Prior to that, you and I can't buy the stocks of privately listed companies unless we're in a specific position. So when they list for the first time on the stock market, their values are closely watched because it often reflects really how investors are feeling about that company. Now, we've seen a pattern over the last few years of IPOs being a bit of a flop. So them listing at relatively high levels and then their value falling quite quickly. This is clearly bucking that trend, only going to show further how important these defence companies are right now in investors' mind. It also goes to show that actually the European IPO market is booming a little bit more than it has done previously. The US, again, has really been the haven of a lot of big booming IPOs. This is a bit of a shift and perhaps does start to indicate a new era for European stock markets. On to then the French economy, where France's news around tax wasn't quite so good as the UK government's. The high earner tax that was introduced last year raised far less than expected for the government, which may put further pressures on their budget and also intensify the debate over how they reduce their tax and budget deficit. Some of this can just do all of the opposite of what I said was happening to the UK government at the beginning when the news was that actually tax revenues had increased slightly. It goes to undermine fiscal credibility and potentially raises political uncertainty in a time that France really does not want it. It might also increase the risk of further taxes, but there was some good news around corporation tax, which was that actually within corporation tax, the revenues have been a little bit higher than expected. But all of this weighs on investment sentiment and growth prospects. So what does all this mean then for you and your investments? Well, it's a bit of a mixed bag, as we can see, but generally, if you've got investments in Europe, we'll be seeing the indications of that slight shifting order. We'll be seeing the turbulence that comes with that, be it from large IPOs within defence companies, or be it from governments having to swallow some of the fears around their budgets and potentially facing increased defence spending as well. It's certainly an interesting time objectively to be watching those market shifts, and those that have got short-term views in mind, well, maybe looking for those short-term opportunities. Whilst most of us will be keeping that longer-term view in mind of riding out, hopefully, some of these shorter-term blips and seeing over the long run steady, sustained growth across that diversified portfolio, no matter what some of these short-term ups and downs have got to throw at us. And last but not least, onto the rest of the world, where first up, China met its 5% economic growth target as their exports offset weak consumption. China's market is heavily made up by exports. Of course, we'll all be familiar with products bought from China. And what this has helped to do is to offset some of the weak consumption that they've seen in recent times. They've also had, for the last 5-6 years, a huge property downturn and slowing domestic investment as well. All of this has impacted their overall economic growth, of course. But with their export market still being strong, they are still more or less able to hit the targets that they're after. China, of course, is a huge growth story, and over the last 30 years, their economy and their market absolutely boomed. That has slowed a little bit in the period since the COVID-19 pandemic for all sorts of reasons, but a lot of them looking inwards to that more domestic market and how that has shifted. Of course, there was also impacts with the global order with things like COVID-19 pandemic and how that impacted supply chains, and now also into the era of Trump and the various different trade wars and tariffs that have been put into place. So what does all this mean then for you and your investments? Well, it's relatively good news. It shows that there is export trade taking place. It shows that despite this era of tariffs, we are still seeing countries' economies grow off the back of international trade. And what that can mean is that if you've got the likes of other emerging markets in your portfolio, the end is not quite, not the end was ever in sight, but the news is better than you may fear. On to then Japan, where volatility hit Japanese bonds, hit the yen, and the Bank of Japan really started to worry a little bit. There's some political uncertainty within Japan at the moment, and they are heavily dependent on how their government bonds perform. This is no small news. It really impacted their stock market as well, and it could have a wider knock-on global effect onto bond values and also other major banks as well that hold, for example, Japanese government bonds. But what does it mean for you and your investments? For your investments, it just goes to show that there is an air of volatility and uncertainty still in the air, and nowhere is quite exempt from that. Japan here is seeing their own political uncertainty, but it's inevitably tied as well to the wider global order. And this will not just impact stocks, but it will also impact bonds and other areas. However, the impacts will be felt differently. So it's not an argument against diversification, but here it is. It's the argument for there's only so much that you can mitigate out. And sometimes when things go down, there's only so much we can do. So don't panic when that happens, because we are globally interlinked. So don't expect to be all perfectly, we call it perfectly correlated or imperfectly correlated. Don't expect it to all be balanced just so. There may always be some things that can't be dodged. And last but not least, onto South Korea, where the Kospi, which is the South Korean stock index, surged. A lot of this has been on the back of semiconductor strength and also various different governance reforms. A lot of this is seen to be narrowing what has been known as the Korea discount. South Korea has been a relatively cheap, in inverted commas, area to buy into for many investors. So despite the fact that as a nation they've got relatively weak economic growth at the moment, their markets are booming. And this has a real appeal to many investors, particularly within the Asia region, but also globally, who are looking for an opportunity that is a midway house. This is certainly one to watch if you look at various different emerging economies and emerging markets to add into your portfolio that may present a little bit of spice. It'll be easy to get your hands on, but it's certainly one to watch, as I say, if you've got interests in different areas or different nations to add into your portfolio too. So I'll move now into the questions. If anybody does have any questions here in the live session, please do feel free to ask away. No such thing, as I say, as a silly question in my book. I know it's quite early in the morning for some of you, but you can ask whatever it is that you want. And of course, if you are joining or watching this later in the week, you can always drop us an email, drop us a message, for example, on Instagram or LinkedIn. You can always find me on both of them as well. I'm always all ears and open to whatever it is that you may well have to say. And I'll leave that there in case you have got any extra questions about our coaching, be it one-to-one or the waitlist that we've got for the group coaching, as well as a link to our Instagram too. Thank you so much for joining. Hopefully you've had a good overview of some of the major headlines there, and it's been a bit of positivity amongst some of the doom and gloom. I know it's not always superbly positive at the moment, but I try wherever possible to make it a little bit more upbeat. I don't think I've got any questions coming in, so I will leave you all to your week, ladies. Have a great day and a lovely week. Bye for now.